Hi, everybody. It's Peter Schiff. It's Friday, June 28th, 2009. Now, I was watching on CNBC during the week, and there was an analyst there. I don't remember his name, but he was talking about the phenomena that he was observing, where foreign markets were much stronger than the U.S. market, and he looked at it as a good sign because, in his opinion, the low quality assets were doing better than the high quality assets, and it showed that people were becoming less risk adverse. And he was talking about foreign stocks being of lower quality than U.S. companies, of emerging market bonds being of lower quality than treasuries. And the reality is he's got it backwards. Foreign markets are not doing better because they're lower quality. It's because they're higher quality. It's the U.S. markets that represent low quality assets at this point. Unfortunately, treasury debt is the equivalent of junk bonds. There's no quality there. The reason that more money is going abroad is because they're fleeing the lack of quality here in the U.S. and they're embracing higher quality abroad. Now, also on CNBC, I was watching Dennis Garthman, who was predicting a rally in the U.S. dollar. And, there are a number of people that have been calling for the dollar to rally as of late. And, of course, it hasn't rallied. That doesn't mean it can't. But when you have a lot of people starting to look for a rally, I think it makes it a lot less likely that that rally will actually occur. In fact, what Dennis Gartman was talking about, he said there's a lot of people short the dollar. It's a very crowded trade. Everybody's short. There's going to have to be a short covering rally. He acknowledged that the long-term fundamentals for the dollar were lousy, but he thought there would be a short covering rally. Well, maybe Dennis Gartman forgot about this, but we had the mother of all short covering rallies in the dollar in late October. In late 2008. That was a big counter trend rally. We had a huge rally in the dollar, in the latter part of 2008, the earlier part of 2009. That was the big short covering rally that he's still looking for. It's already happened. I doubt it's going to happen again. Certainly not of that magnitude. I know that I was very short the dollar in 2008. I wasn't short on leverage. My clients owned foreign stocks and foreign bonds, and so when the dollar unexpectedly rose in 2008, it brought down the U.S. dollar value of those assets. Now, we weren't leveraged, so we weren't forced to cover like a lot of the speculators were. But I think that trade has already played out. I think we've had that short covering rally, and I think the dollar is actually getting ready for another leg down. I think that's far more likely than a spike up at this point. I think the dollar has been consolidating its losses. The chart patterns look very negative to me, and I think that there's more likely going to be a big move down in the dollar rather than a big move up. However, if there is a temporary move up, again, I think it will only be a short covering rally. It will not be as strong as the last one, and I think it will be a selling opportunity if it arises. Also today we got some economic data. Personal spending was up about 0.2%, but incomes were flat. And of course, Wall Street is happy that spending is up. Of course, that brought the savings rate down from 4.5% to 4.2%. In other words, we're going backwards. All this government money, all this cash for clunkers, money for new homes, free money, spend, easy credit, is now reversing the positive movement we had to a higher savings rate. And we are digging ourselves into a deeper hole. I reported a show that you can see your money on CNN on Saturday and Sunday and got into an argument again. The host's point was that, the government, we need to spend more money. We need bigger deficits. We need to spend our way out of this crisis. I pointed out we can't spend our way out of the crisis. We spent our way into the crisis. That is the problem. More government spending, more debt is not the answer. It's the problem. It's the cause of the problem. The solution is the savings. We have to produce our way out of this. We have to deregulate our way out of this. We have to export our way out of this. We have to save our way out of this problem. We can't do the opposite. Also, quickly wanted to mention on my radio show, Wall Street Unspun on Wednesday, I mentioned that with respect to my Senate race, that if I raise $1.5 million total, then I'm in for sure. Now, the reason I did that is I was contacted by some people who were doing a money bomb that I guess is scheduled to explode September 10th, and they called me up and they asked me if there's a specific dollar amount that I could commit, that if we raised it, I would be in for sure. Now, I've never had a specific total. I've been talking about the fact that I wanted to get to $1 million because I'd like to announce my candidacy with over $1 million raised, and that's still the point. But they asked me to commit to a particular level, and that's where the $1.5 million. I said, sure, if you want to market that, if you want to say, raise Peter Schiff $1.5 million in total, and he is guaranteed that he will run for sure 100%, that's what I agreed to do. It doesn't mean that if I don't raise $1.5 million by the money bomb on September 10th that I don't run. It simply means that I have been willing to make an absolute commitment so that we can motivate the troops, encourage more people to donate and get their friends to donate if they have an actual goal that says, yes, if we raise this amount of money, he will run for sure. So anyway, that's it. So I wanted to say today. Have a great weekend, everybody. I'll be back again soon.